The final question, question 15, it says that the owners wish to receive 50% of the profits as dividends in the coming year. Right, well, firstly, because we're saying we're not paying it now, we know it doesn't affect our cash in our bank. So if you wanted to total them, by all means do so. Right, but it says 50% of the profits. Now, from their income statement before, we can see that this is how much profit the company actually made. 300,358 euros and 46 cents. So they want to receive half of this in the following year as a dividend. Now this is where we've got the understanding. A dividend is basically the money that is paid to the owners. This money belongs to the owners of the company. Now, depending on the size of the company, they can just say, give me all that money, or whatever the case is. There could be board of directors who decide they want to share a part of it. There could be individuals who want to take a piece of it. But in this case, they're choosing only to take half of it. And that is their entitlement, of course. They can take it all if they wish. But if they're only taking half of it, that doesn't mean that the other half stays where it is. It means that the other half is still owed to them to be paid at some point in the future. So this is the thing, so irrespective of how well the company does, this money always at the end belongs to the owners. And that's the concept. So when we talk about a dividend, any dividend that isn't 100%, which means that they take all the profit, which could be due quite short of cash, means that you're technically increasing your debt. So what we're going to do for this, firstly, the dividend that they want to receive. So the dividend, which is their payment that they're going to get this year. So we've got the dividend. Now, of course, the dividend, what we're doing with this is in the income statement. At the beginning of every year, the income statement starts with 0. And this is why we need to account for what happens to the profit once we've established it. And so the dividend and what's going to be the retained earnings, as in the money they don't take, are going to be subtracted from this profit to bring it back down to 0 for the start of the new year. So in the income statement, you will see this. So what we're going to say, we're going to call this a dividend. Now we don't call it a part of, but this is why I refer to these as post-profit costs, because this is a cost to the company that we incur after we've calculated our profit. So we've got the dividend. Even though, yes, it's a positive thing, it's still a cost to the company because we are paying the owners. The owner is a separate entity. So in our case here, the owner wants 50%. So 50% of 300,000, 150. Right. So the owners are going to get 50% of the dividend sometime in the next year. It says in the coming year. So that means they have decided to leave us a while to generate money, generate sales, whatever it might be. But again, we know because it's due during the next year, it's a current liability, and because it's a dividend, we call it dividend, and because it's a current liability, we call it payable. If we're unsure even what side it goes on, naturally this is on the debit side or the left-hand side, so of course it's going to go on the credit side. But from a logical point of view, it increases the amount of money that we need to pay as a dividend over the next year. And that's the first part to it. So we've actually reduced the profit we've made because we've subtracted the money we are going to pay as a dividend. But that's only 50% of it. We still have the other 50% to account for. We can't just leave that money there. We have to determine what is going on with that. And that's what is called a retained earning. And just as EBITDA refers to, say, the profit, this is what we're referring to here again. The earning is the profit that is made by the company at the end of the year that they are choosing not to distribute, or the owners are choosing not to take. And by extension, it is retained by the company for use elsewhere. But because it's retained, as I mentioned before, it is owed to the owners. So we're going to do the same again. We know that we're going to get down to 0, so what we call the retained earnings, again, we're going to call this a cost, and it, of course, again, is a 50%, it's 9.23. And this now means that these two costs being taken away from our profit brings our income statement back down to 0, and we need to account for it. Now again, we know 150, 179.23. We know that it's a retained earning. All we have to do is figure out where it's going to go. Now this is obviously money that we're not going to pay them in the next year. So you could technically say it's going to be a long-term liability. And you would be correct, except, of course, we are talking about the owners. These are the owners of the company. We account for those separate to long-term liabilities. We account for those as part of capital. And so therefore it increases the capital, and by extension, it increases the amount of money that we owe to the owners. And that is basically question 15. Now, when you have question 15 done, that means you are now in a position with all of the T accounts done. You can calculate the totals of all the T accounts and put them into the balance sheet. And in the balance sheet, as we mentioned before, the reason it's called a balance sheet is because it's a sheet that balances. You must make sure that the left and the right side of the balance sheet do actually balance. Then you know you have got all of these calculations correctly. Refer to the Excel sheet. The numbers there are correct. They go directly to this. It will tell you where the numbers are calculated from, and but that's basically the entire question.